name's Marco. I'm from the Charter Hall Direct team. Today I'm joined by the Portfolio Manager for the Charter Hall Maxim Property Securities Fund, Jonathan Kriska. Jonathan, very interesting times in investment markets at the moment. What's your current view?
Yeah, so the last 12 months we've had a real transition both in the sort of global economy and the Australian economy. We've seen a period, if you go back a year ago, economic growth was looking pretty good. The outlook for interest rates was certainly looking like they were going to go higher. Roll forward 12 months to today, and what we're seeing really now is a lot of economic data showing that both the US and the Australian economy are slowing. We're not going into recession, but we're slowing. And as a result, reserve banks both in the US and Australia have been reacting to that and lowering official rates. So on the back of that, we've had quite a bit of volatility in financial markets, particularly bond yields. We've seen now at record lows both in Australia and the US. For commercial property, that tends to be pretty positive. It changes the relationship between interest rate investments. So we've seen commercial values be quite strong over the last 12 months, and the REIT sector do really well. In fact, for 12 months, Aussie REITs have done about 18% versus 12% for the broader market. We certainly sit in the camp of, we think going forward we're lower for longer in terms of rates. In that environment, we think that's going to be positive for the REIT sector. And I think also looking at the Aussie dollar, which is now lower, that I think is going to help further put some fire in terms of M&A transactions within the REIT sector.
Jonathan, what's your current view on active versus passive management?
Yeah, it's a good question. It's a very topical point, I guess, in financial markets these days. Look, we believe in the market being still inefficient, and therefore there's room for certainly active management. We think that's certainly the case as you drill down into the small caps. Typically, you don't see a lot of broker coverage, maybe no broker coverage. That gives you opportunity to find little gems that others don't know about. Also within the REIT sector, there's a few structural inefficiencies the way the sector's put together. There's roughly about 8 stocks which comprise 80% of the index, and the index is very tilted towards the retail sector. So we don't think that's great from a diversification point of view. And also, if you were sort of to pair up which sectors you want to be in, probably retail is not at the top of your list, it's probably down the pecking order. So from our perspective, we believe in active management.
Jonathan, what are the types of investment characteristics do you look at when investing in the property sector?
Look, I think it's firstly important to realise within the property sector, you've got traditional style REITs, which are rent collectors, and at the other end of the spectrum, you've got effectively companies which are like property developers, fund managers, and seniors living operators. And then in between, you've got these hybrid stapled structures, say like Stockland, which is a combination of both. And the way you have to approach each of those structures is quite different. I would say, however, that one of the key things that we do overlay and think about is management quality. And we think that can often make a big difference between success in terms of performance. We spend a lot of time looking at sectors and understanding sectors and trying to form a view on sectors. I think at present, we're pretty positive on the outlook for the fund managers, given what's happening with bond rates. We like seniors living operators, given the ageing thematic. Office has been strong, but we think that's moderating. The industrial sector is still looking really good with the logistics and the Amazon sort of online phenomenon. And retail is finding it a bit tough these days. Looking in terms of each of those structures, so if we turn back to sort of traditional REITs, a lot of it is actually looking at the assets, the tenants, the quality of those. We're typically valuing those on a combination of yield versus premium to NTA. In terms of companies, if we're looking at, say, a seniors living operator, we might be looking at how many settlements they're doing each year. If it's a fund manager, we might be looking at the growth in funds under management. And, given their companies, we're sort of looking at the growth in earnings versus a relative PE.
Jonathan, from a property perspective, what's your view on childcare and early learning centres?
Yeah, we like childcare. It's important to realise the childcare space has undergone tremendous change in the last 20 years. I think there's been a sort of a realisation that these are no longer glorified babysitting centres. In fact, kids who go into childcare, there's evidence now that they're better prepared when they go into proper school. And so we've seen a growing proportion of kids 0 to 5 using childcare, and that continues to this day. That's been really positive for the operators. They've been driving good daycare rates. So when you sort of turn to the real estate, that has meant that the landlords have actually been able to drive above average rental growth. And we're seeing actually under renting evident in childcare REITs, which is quite often different to what we're seeing in some of the retail REITs. From a real estate perspective, we've got long leases, we've got triple net leases. They're great things to have. We've seen some of the best cap rate compression in childcare. So we think it's got a good outlook and we like that sector.
Thanks so much for joining us today. To find out more information about commercial property markets, Charter Hall, or our current investment opportunities, please feel free to contact Penny and Rose at PWM Advice. Thank you.